All right, morning guys. Thank you very much for being with us. Just a couple of minutes, 1 hour ahead of the start, ahead of the opening bell of Wall Street. New week with lots of happenings and with lots of things that we are going to cover in this with this one and a hour of presentation. So let's just start. We have a couple of great materials we have prepared for you. So first of all, just to cover what happened last week, stocks rallied in the past week after the Fed appeared dovish when it said it did not see strong enough data yet to raise interest rates from zero. And we are talking about it a lot, and we are all waiting for the Fed to hike its rate. But it did suggest that there could be one or more hikes this year once the economy improves, and this is continuing to be one of the major issues that concern investors when the Federal Reserve is going to hike its rates. However, the rally faded and stocks sold off Friday as traders positioned for the uncertainties surrounding the meeting of Eurozone finance ministers and officials today. As we speak, actually, the meeting is taking place, and there were also concerns that Greece, after securing emergency funding from the European Central Bank, would still see a run on its banks. Now, first of all, looking right now on the futures on S&P and the Nasdaq futures, they are going up sharply, about 1% up. So that means we are going to start this day with a gap up after European stock exchanges were traded higher all through the day, and right now investors are expecting some sort of a good resolution for Greece, but you know this rally can very fast get faded, so we shouldn't just rely on what is going right now in the pre-market. And actually, you know, I'm going to position myself on a bearish note. I'm going to position myself to the bearish side, and you'll understand soon why. Now, the good news about next week. So just to make a quick recap of last week, the S&P 500, although it sold off on Friday 0.9% down, it was able to finish the week on a bullish note, going up 0.4%, and year to date it's already up 2.5%. Not a lot, and we talked about about the S&P 500 that hasn't moved nowhere, that actually moved nowhere since the start of the year, 6 months into the year, into this year, 6 months into the year, this year. And actually the highest point the S&P reached was 3.5% at its peak and 3.5% at its ebb. So that gives us a range of 7%, and you don't have even one occurrence instance in the history where the market was traded in such a tight range so much into the year. The Nasdaq was up more than 1%, and right now more than 6% year to date. And the IWM, this is the Russell 2000, the small caps, actually more than 1.5%, was the strongest index from the major indexes, and right now it's taking the lead once again, almost 7% year to date. Just look on the IBB. This is the ETF that tracks the IBB tracks the biotechnology, and the biotechnology actually jumped almost 4%, and this is a leader. We saw this group leading the charge since the start of the year, and actually for the last 3 or 4 years it was top performer. Right now more than 24% year to date. Actually we saw last in last week presentation, we saw actually the great IPO, the great debut of AXON, which was the latest biotech firm that went on an IPO, and as you remember, it surged. It's actually doubled its price in the first day of trading. And later on, we are going to see which IPOs are going to the market this week, which IPOs are going to hit the market this week. We are going to have a very busy week. Considering the IPO arena, as we are going to meet 14 new stocks, and of course we are going to tell you which one are the most quality one, which one we should focus on. Okay, now right now the good news about this week is that Greek financial hostage situation will soon end one way or the other. And while that is good news for Europe, that bad news is that it seems to be ending dramatically rather than quietly. I've been sending cautious messages all the time recently, in part because this Greece situation is a bit of a lose-lose proposition, at least in the near term. This is partially because I do not expect any dramatic action to take place today, as the 19 leaders of the European countries are getting together to figure out what should they do with this problem of Greece. I wonder if we won't immediately hear from the various Fed heads that with Greece settled, the Fed will soon raise rates. I almost expect that to happen, and if no deal is made, then the dollar once again will continue to rally, and the earnings will suffer. That takes us to the bottom line. Either way, both roads actually lead us to a sell-off this week later. But there is more why we should be a little bit cautious heading into this week, and that comes from the statistical point of view. See, according to Stock Trader Almanac, the Dow Jones has been down 22 of the last 25 years in the week after June expiration Friday. Now, we get the expiration day once a month. This is the third week on Friday, the third Friday of the month, and that was on June, and that was last week, and this is actually why you saw a peak in the volume. And so the Dow Jones went down 22 of the last 25 years on this week, for an average loss of 1.1%. Now the S&P 500 in the meantime has been higher only once in the week since 2003. So this, at least from the statistical point of view, gives us a very good direction to be bearish. And you know, it's not that we are going just to throw shorts all over, but that means if I get the excuse to get short the market today or anyway tomorrow, I'm going to pull the trigger on the short side. So my suggestion right now is just wait and see. The worst that could happen is an investor misses a rally that was on top of an already gigantic one that brought the Nasdaq to all-time highs last week on Thursday, and we are going actually to see in a couple of minutes the great rally and the great roller coaster that took the Nasdaq from its bubble of the dot-com early in 2000 down to the ebb around 2002, and then all the great rally, the wonderful rally, the magical rally that took the Nasdaq back from the bottom of 2002 and 2009 to new all-time highs last week. Warning alarm at the last minute is right now ringing, and this term could be applied to a variety of different issues swirling around the market right now. Now, Greece is definitely coming down to the wire and running out of timeouts. Regarding the Fed, the era of zero interest rate policy is also getting close to the final buzzer, but the game is already in triple overtime, and while another period is unlikely, in the words of Yogi Berra, it ain't over till it's over. Now, the warning alarm I'm talking about is for the first half of the year, and we have just 7 trading days left to go in the first half of the year. That tells us that the first half is about 98% complete, which equates to the 28th minute of a pro football game where the referees would be blowing the whistle to stop play so teams can get ready for that one final drive of the half. So far it's been a defensive battle for the most part of the year. The Bears actually, and you can see, and right now I'll just go to the to my screen. This is the S&P 500, the SPY that tracks it, and we can see here the start of the year of 2015, and we saw the Bears started out with a strong drive to start the year. That was a very bearish January to start of the year, but fumbled at the goal line, and the Bulls actually drove all the way downfield. Since then, both the Bulls and Bears actually have had their red zone opportunities, but neither of them actually has been able to convert. As we head into halftime, though, the Bulls are driving once again, but the Bears are going to use the timeout to try and make a final stand into halftime. Whatever the outcome, it's been a tiring back and forth battle. We are now going sideways for the last, 4 months or so since March, and there's no resolution so far. And the side with the most stamina is going to have the upper hand in the second half. So for active traders out there, actually, and most of us are active traders, the recent choppiness of the market is enough to make you pull your hair out. Back in early June, and you will see early June in the red arrow I drew on this chart. The S&P 500 actually broke its uptrend from December. Okay, broke it down, and right now, and the ensuing days it tried to rally back, but got paused just right at the former uptrend line last Friday. Now, that resistance sent the Bulls home for the weekend on a bad note, but then after a week open on last Monday, stocks actually ran throughout the week up until Thursday. On Friday, equities took a bit of a breather, but closed out the week right on the uptrend line, and this is like 1 second left on the clock, and the Bulls having fourth and short dip in the Bears red zone. Can they convert? Can they have the winning goal? Let's get to the S&P 500 and see what is going right now. So the S&P 500 may have come up just short of a new high in Thursday's rally, as we can see right now, but actually and many of the other major averages made new milestones last week. A mere glance at the long-term weekly chart, and it's not worthy because it eliminates the background noise and volatility on the short-term chart. That the weekly chart actually paints a market still traded at an uptrend, even though the gains have been devoid of momentum these past months. In the meantime, the 20-week EMA, the exponential moving average, this is the blue line on my chart, actually was able to provide the necessary support for all of the year, since the start of the year, pressure increasingly on the rise in advance of a significant breakup. The short term, in the short term right now, the S&P 500 is trading in a volatile manner, changing directions almost weekly, and this is we can see on the daily chart perfectly, and it's freely alternating between seeking support from below and facing resistance from above. On the one hand, whenever the SPY actually declines to the zone of the 207, and let's just draw here a line. This is the 207, and you saw a couple of times that the S&P 500 got a support there, and even thereafter we have another solid support around the 204, and the buyers pounce to buy up stock on the market at these levels. Just note that around the 204, this is the major horizontal support. We also have the coincide rising 200 moving average come exactly at this point, so this is actually strengthening this point, this support. On the flip side, anytime the market approaches the zone of 212 to 213 point level, profit taking prevents actually the market from going any higher, and this leaves us at this tight range. The next leg will materialize only with a significant break out or breakdown of the all-time highs situated right now at 213.50, or with a breakdown of the latest significant bottom in 204 point area. Until then, the market is expected to stagnate, simply biding its time. But let's moving from the S&P 500 to more interesting charts like the Nasdaq, and here is the Nasdaq 100, the ETF that tracks it, the QQQ. And the Nasdaq not only made a new bull market high last Thursday, but has also now taken out its intraday high from the 10th of March 2000. So actually it left all of the mess of the technology bubble, of the dot-com bubble, in the rear mirror, and right now it's free from all its history, and it's in a new ground, and that is very, very bullish. Let's get to the Russell 2000. And let's see if I have it on the chart. I do have it on my chart, and if you want just to trade it or even to look it on your CoreMex platform, you just need to type IWM and you'll get it on your chart. The Russell 2000 also took out its April high last week, and as the chart in front of us right now illustrates, small caps have been riding a solid uptrend, a solid uptrend, and actually this is the uptrend that started after its sell-off in early December. As long as this uptrend holds, bulls have little to worry about. It's also worth mentioning that even as stocks sold off Friday, the Russell 2000 was nearly unchanged on the day. And maybe we can have it get a look on the chart, on the results chart here, on the scoring card. Here's the IWM. Actually, it was barely changed on Friday, although the S&P and the Nasdaq were significantly went sharply down. This is not what a market top looks like, because I get a lot of people asking me, Shlomo, tell us, is it the topping? Does the market do you think the market has another leg up? Do you think the market can go higher to a new all-time highs? Hey, it has been going up for the last 6 years. How much can it go upward? And my answer to them is, firstly, we have to analyze the economy for that, because it's not the chart that is going to tell us when it's going to stop. It's just the economy. And secondly, looking on the chart, there is no any sign right now on the horizon that tells us that that gives us any alarm, any warning about something that is going to happen, that is going to shaken out all of this great uptrend for the last 6 years. Probably most important to me is the small caps breakout on Thursday. There is a study that has been done that forward moves by the S&P 500 are above average when you get breakout moves. So without the signs of a market top, I think this uptrend is going to continue. So while Nasdaq and small caps, they all broke out to new highs last week, actually the transportation sector continues to slump, and after making three lower highs from late 2014 through early 2015, and I'll just try to put it here on the chart. So this is the latest high in December, last December, another lower high in early January, and another double top around March and April. From there, actually, the transportation headed down, and right now the transportation have been in a bearish downtrend. Now, if you want to trade this one or just want to watch it, this is just, a snapshot from my CoinMex platform, and you can just write on, you can just type IYT on your charting platform. This is the ETF that tracks the transportation. Traders with a more optimistic view of things are looking at the recent sideways since the start of June as a possible double bottom right now, even a triple bottom, but I think it's still way early to tell. We have discussed the divergence between the transports and the rest of the market in detail over the last several months here in the Investors Club, and while it's marginally better to see the two moving in the same direction, the divergence is in no way a guarantee that the broader market will follow suit. Not only that, but the US economy is a lot less reliant on manufacturing as it has been in the past. And I'm mentioning it because Charles Dow, he was the inventor of, what we call technical analysis. He actually established the Dow Jones index that we all follow, which is one of the most popular financial index in the world. And he actually mentioned that one of his most important rule was that the transportation need to give us a confirmation of what is happening in the largest indexes. Back in his times, the larger index was just the Dow Jones, because the S&P 500 was established only years after he established the Dow Jones index. That was around 1928, if I recall correctly. All right, so it will be nice to see the Dow Jones comes up, and if it comes up and make some sort of a recovery, probably getting over this downtrend resistance, this will be a very good, a very good tailwind for the market. But currently we see a new all-time highs when the transport are at the bottom, and that just tells you how strong is the market. All right. Yeah, absolutely, Jay. I completely agree with you. This is one possibility, but right now, because of the strength of the market, probably you might want to consider a long around the support level with a tight stop just below the recent low. And again, we can just trade the IYT to get an exposure to the whole group, or to find specific stocks like FedEx or UPS, or one of the rail companies like CSX, Union Pacific, UNP, and so on. Also KSU, I think, is one of the members in this composite. All right, let's move on. And we want to discuss a little bit the roller coaster of the Nasdaq since 1998 till 2015. And after more than 15 years of downs and then ups, the Nasdaq Composite eclipsed its intraday high from the 10th of March 2000 on Thursday. And just to commemorate this milestone, I wanted to highlight the top performing stocks in the Nasdaq Composite from 10th of March 2000 through the point of Thursday when it hit the new high. And just remember that the average stock here in the Nasdaq for the last 15 years actually done nothing, actually moved nowhere. It went down, it went up, but finished at the zero line. So it will be nice to see which stocks actually prospered in those times, and you just and this is just mind-blowing. You're not going to believe what I'm going to show you in the next analysis. So believe it or not, there are 99 stocks in the index of the Nasdaq that are up 1,000% or more during this period when the Nasdaq was doing nothing. While we don't have enough space, space or time to mention all of these 99 stocks, the next table right now is actually gives you list for you the 19 stocks that are up more than 4,000% during this period. And just to give you the correct impression, 4,000% is 40 times your money. Any dollar translated into $40, that gives you $100,000, or let's say $10,000 actually was translated to $400,000. $100,000 was translated into $4 million during this period. And one of them, if you go down the list, you are not going to meet Apple. And I believe most of you are just trying to understand where is Apple and why Apple is not in this list. So Apple actually has had an impressive run, but with a gain of only 2,750%, it came up just short of making the list. You have a stock must have at least 4,000% in the last 15 years to appear in this list. Looking at this list, there are a lot of interesting names. When you think of high flyers, the consumer staples sector is usually not the first sector that comes to mind, but the two top performing stocks right now are both from the consumer staples. And we can see here Monsanto, Monster Beverage, MNST. This is the top of the list with more than 50,000% since in the last 15 years. Actually, at the top of the bubble, of the dot-com bubble, it was traded for only 27 cents, and right now at around $134. This is more than 50 times your money, more than 500 times your money, 50,000% since the last time the Nasdaq traded at these levels. While GMCR, also another one from the consumer staples, has rallied nearly 21,000%. That gives you something like 210 times your money. It's also ironic that both stocks are companies that Coca-Cola has taken a large stake in, although Coca-Cola took these stakes after the big runs in those stocks. Outside of these two names, some of the other well-known names include GILD, that we trade here in the trading room almost every day. We really like it. It comes from the biotech space, and also Express Scripts, ESRX, from the HMO space. Also very, very interesting with what's happening right now in Cigna, with the buyout that Cigna got, and maybe Aetna is going to get another a buyout. So ESRX actually more than 4,000%. Perhaps the most surprising aspect of this list is the number of stocks that aren't household names, aren't popular names in our portfolios, investment portfolios, even after the big runs they have had. And one sector that is absolutely absent from the list here is technology. You're not going to find even one single technology stock in all of this list. So although it is one of the largest sector in the market of technology, not a single stock from the sector made the list. And the reason for that is very, very simple. Every stock in that sector that was publicly traded at that time, at the at the top of the dot-com bubble, was center stage in what was one of the most vicious slaughter, one of the vicious, greatest stock market bubbles in a generation. Morning, Jonathan, and welcome aboard. Okay, moving forward, we talked about China in our last meetings, and actually we recommended to take a chance on China, and actually we listed in previous sessions the most interesting ETFs that tracks China, and China is just very, very hot, the hottest area in the world, around the globe, just from the point of view of stocks, of performance, not economy. And one of the ETF that we mentioned, and we will keep mentioning, is the ASHR that you can see just now. This tracks the 300 stocks of the Asians, that shares that are actually being traded in Shenzhen stock market and Shanghai stock market. Our pick was actually to get into the ASHR, to take a chance on China around here, around 38.50, and you can just browse. Browse down the list of the videos we have on YouTube to get a recall on that. And as you can see, actually the ASHR China went from 38.50 till 55. That gives you a run of about 50+% in the last 2.5 months, and it can't get better than that. Now, China has been all over the news last week, and given the massive selling that's been underway on the Shanghai and Shenzhen exchanges last week, it's not hard to see why, and you can just see the pullback it had last week. And actually, the 12.73% decline from its high close on the 8th of June puts it in official correction territory. Usually, we designate a correction territory as a financial instrument or any stock or market that went down more than 10% since its last peak. One striking fact, though, is the upside in Shanghai has been so huge that it actually took a full correction for the index just to catch up with its rising 50 daily moving average that you see here on the dotted line. The index's 6.5% decline on Friday took it below the medium-term trend line for the first time since February 9th. This was February 9th was the last time actually the ASHR traded below this very important moving average. And usually on my chart you are going always to meet the 20 daily moving average, the 50 daily moving average, and the 200 daily moving average. Each one of them is actually tracking after another period of the market, the short term, the medium term, and the long term. This is the 200 moving average. Now, I've heard numerous hand waving about the risks to global markets of the Chinese sell-off lately, and my response is very, very simple. If Chinese A-shares were totally uncorrelated on the way up, why on the earth should they be on the way down? So the next chart is actually going to show us the Shanghai Composite and the S&P 500, they are all charted on the same chart back to 2009. You're going to see the S&P 500 on the blue chart and the Shanghai Composite on the bright chart. And as you can see right now, the two don't have an even vaguely similar pattern with very, very low correlation. By the way, most of the time the S&P 500 went upwards since 2009. Actually, China spent the time going downwards, and just since the start of 2014, even not 2014, since 2013, actually China went sideways. It was one of the most dull place around the financial world, and just since 2015 or late in 2014 it actually was able to raise its head and walk forward, and and this is just astonishing. This is just eye-blowing, and and this is exactly what we are doing here in the Investors Club. We are trying to put our fingers on the hottest spots that we as individual traders can make money, some of the most interesting places in the financial world. To be sure, I have some concerns over the effects of Chinese growth on the global economy, but if there was ever a poster child for the stock market is not the economy, it should be onshore equities in China over the last 6 months. Despite a continued slowdown in money supply growth, industrial output that is going downwards, and other economic indicators, and we are hearing that every week about what is going on with Chinese economy, and how how the Central Bank of China is trying to make all sort of stimulus in order to push China out of the slowdown. Recently, China stocks have rocketed higher since then, and as traders we just want to monitor right now the pullback. Usually, no market, no financial instruments is going to end this kind of phenomena with just one touch. Usually it's needing more than one touch to end an uptrend. So usually you can bank on the fact that at one point in time, and sooner rather than later, China will try to test the prior high, and maybe even to make a higher high and to continue its great uptrend. So just just making a note about that. But by the way, if you are not a swing trader and you are just day trader, there are lots of stocks, Chinese stocks, in the US market, and we are trading them every day. Just think of Kihu 360 and just look what it made. WUBA that had a great run since March. What you will say on WB, also in a great run right now. And so you can just focus on the Chinese stocks, also Sina, on the Chinese stocks that are part of Wall Street that are trading in our market. Let's go to the economy scorecard, and let's see what happened last weekend, with economic data having increasingly more importance as the ultimate day of reckoning approaches. That last week was positive for investors who want the Fed to stay in the parking lane and don't come and push on the hiking rate button. In what was a quiet week for economic data, the majority of reports we saw last week came in weaker than expected. As we can see, a lot of red right now on this list. 5 indicators actually came in better than expected, and they are colored in green, and 7 missed expectations colored in red. That being said, there were some bright spots. Also 2 of the weaker than expected reports actually were the CPI and the core CPI, and those actually caused bulls to breathe a sign of relief. Of the remaining weaker than expected reports, the biggest disappointment was probably industrial production and the housing starts. And now the weakness in housing starts, however, was more than offset by a strong building permits report and solid sentiment on the part of home builders. So, and additionally, weekly jobless claims also saw a nice decline to what was one of the lowest weekly reading of the recovery. Let's move forward to this week economic calendar, and this week the pace of economic data will pick up again with several key reports. Wall Street will await existing home sales, durable goods orders, new home sales, and consumer sentiment. And just to to give you a little bit of understanding what all of these reports mean. So just let's see. So for example, existing home sales provide you a gauge of not only the demand of housing but the economic momentum, and durable goods orders reflect the new orders placed with domestic manufacturers for immediate and future delivery of factory hard goods. So that means buying machines valued in millions of dollars, and no manager of a big company is going to order a very big expensive machine if he's not very confident about what his financials is about and what orders his company has in order to make such a big consumption. So just to understand that this actually, the durable goods orders, gives us some sort of the confidence of the managers that are leading US firms. New home sales measure the number of newly constructed homes with a committed sale during the month, and the consumer sentiment, this is the Michigan Sentiment Index that is going to come on Friday, is directly related to the strength of consumer spending, which accounts for more than 2/3 of economy. And by the way, earlier on Thursday, we are going to have these figures, directly figures of the personal income and personal spending. We are going to see what is the personal income. That means whether the average American citizen, his personal income is going higher or lower. And what about saving? We want to see all the citizens in United States spending their income, not saving the income, because saving actually indicates us that the US citizen is taking a cautious stand, while spending just tell you about the atmosphere of the Americans. Like they see a bright spots, they are living in a very bright atmosphere, their salary, their wages maybe are going higher, and therefore they have confidence in their in their working place, and therefore they are letting themselves spending more than saving. And that tells you actually, and this is being translated immediately into the US economy, where the 70% of the GDP, of the growth domestic production, is made from the very average John Smith that lives in California. Okay, by the way, let's move forward and let's see which IPOs are going to be on the deck. And we had a great week in the IPO arena with the FIT. All right, let me just okay. just got disconnected. I want to show with the chart, so let me just reconnect my system, so I'll show you that. Okay, so back to my chart, and this is FIT. We talked about it last week. We mentioned it. It's going to be a very, very hot IPO. And by the way, on the first day, I get this. Okay, on the first day, actually, we got FIT jumped over about. It actually started with a liftoff of 50% surge on the first day, and as you can see, it continued higher on Friday, and right now it's up. It's going to start the day with a gap up. So actually, FIT is very, very hot right now. This week is going to present us with no less than 14 IPOs. And by the way, we took FIT as a day trading on Friday. Just want to show you that. I'll get back to. All right, 1 minute. I want to show you that. Let me show you that. Let's get back to the daily. Yeah. Okay. So I'll just get rid of. Okay. I'll just get rid of. All right, so these are 3 moving averages, but I'm not seeing them, I'm not watching them when I'm trading, and just see how the S&P 500 went down all of the day on Friday. And when we see FIT, and I'll show you exactly where I took it, I'll just erase all of the moving averages. Okay, so it went up, and just see what a nice cap and then it made for us, and our call on FIT was above 31.50. Now usually we tend to buy stocks, IPOs, after they are breaching the high they achieved on their first day, on the debut. So that was 31.90. So actually we were able actually to take it in advance. Before it actually went above the high of the first day. The high of the first day was around here, around 31.90, and what a nice ride. Actually, it went from 31.50 directly to about 34. That is about 10% rise in a matter of 30 minutes, and this is exactly the potential of day trading. This is why we like day trading, and you know, I'm also swing trading it from Thursday above the high of the first day, from 31.90. Hopefully we are going to I'm going to ride it till 40, and of course I'm just right now going to adjust my stop below each day's low, but hopefully it can get up to 40. It's not very rare to see a stock jumping about 8 or having a movement of $8 to $10 after it break out the high of the first day. Now David is asking whether I'm using the 50 EMA. So I'm using the 50 EMA anytime I'm using the exponential moving average, not the simple moving average, all right, because it's much more fast than the just simple moving average. But I'm not watching the moving averages on an intraday chart. I'm using them only on a daily and weekly chart, and hopefully we will have some time to watch this. So let's get just to the IPO we are going to have this week. 14 of them are going to come, and so it's going to be another very busy week for the IPO. Also worth mentioning that 8 of the IPOs are going to hit the market all in one day. That is going to be on Thursday. So guys, get prepared for Thursdays, because we are going to be busy over the head with 8 different IPOs, and there are a couple of and here are the most interesting IPOs on Thursday. First of all, TransUnion. TransUnion will make its trading debut on Thursday. This company, whose competitors include Equifax and Experian, if you know them, it actually sells credit reports to help lenders assess the credit worthiness of borrowers. TransUnion filed for an IPO back in 2011, but actually it withdrew the offering in 2012 after it was told to Advent International and Goldman Sachs by private equity firm Madison Dearborn Partners and Pritzker family. This is going to be something nice. You know, it's a financial company, so usually the IPOs of the financials are not very, very hot, but you know, there were already cases, so we are not going to pass, we are not willing to pass on this one. Next one is Wayne Farms. This is the 6th largest poultry producer in US, and it will also debut on the same day, on Thursday. Wayne Farms clients include companies like, just for you to get an indication, it's Nestle, it's Costco Wholesales, it's a Chick-fil-A. This is a fast food chain known for its chicken sandwiches. So the company is one of the daughter companies of Continental Grain, if you have heard about them, and this is among the largest privately held US corporation. If you are going to track our daily trading report, or you are going to visit my Facebook page, you are going to get every day which IPOs are going to be on the deck, so just follow that and you will be okay with that. All right, moving forward, and we are getting to our weekly game plan, and let's see which stocks are the most interesting, which stocks are actually going to deliver the reports. We are right now stuck in the middle of the off-season for the earnings reports, but still we are going to have a couple of very major companies that are going to deliver the latest financial reports, and of course, they are going to be very, very interesting from the point of view of trading, of day trading, and let's see what to expect from each one of them. So we are starting on Tuesday, and on Tuesday we are going to have Carnival Cruise and Darden Restaurants. So about Carnival Cruise, and let's just put it on the chart. This is CCL, and let me just get back the moving averages, so it will be much nicer to see. Back to CCL, all right, Carnival Cruise, and speaking on the moving averages, just look how the rising 200 moving average supplied a very nice support for the stock around May, and from there it was just shooting up. Right now you see the gap up. Many stocks are gapping up right now early in this week ahead of the start. So this is going to be on Tuesday. Carnival Cruise, this is the world's largest cruise operator. It's expected to report second quarter profit and sales above analyst average estimate. The company is expected to be helped by higher booking and online spending by consumers, particularly in the Caribbean. This is its largest market. Investors will also be looking for Carnival's third quarter forecast, when the company usually earns the largest share of annual profit due to the peaking demand in the summer. You know, all the children are out of school and are on their vacation, and lots of families are just booking for their yearly vacation around the summer. So CCL looks very, very good looking right now on the chart. Let's get to DRI, Darden Restaurants. It's going to report its fourth quarter results also on Tuesday, I believe, after the market close, and this is the owner of the restaurant chain Olive Garden. It has many other well-known restaurant chains, and actually right now investors will be looking for the 2016 forecasts and further details on the company's new cost-saving initiatives and property deals. Darden has mentioned last quarter that it was looking to create value from real estate after traffic at its flagship Olive Garden chain continued to fall. Looking on the chart, people really like DRI, and by the way, we see a recovery for all the restaurants names for all the restaurants stocks. And for example, we had just last week a wing that when again we have a problem with the moving averages. It's just squeezing the chart, but we have a very successful debut for wing 2 weeks ago. Also went up sharply on the first day, and on Friday we had Fogo. This is a Brazilian restaurant chain, and actually it went up 20% on the first day on Friday, and right now seems it's going to go over the high of Friday, and maybe moving forward. We are moving to Wednesday, and on Wednesday we are going to have Linear. All right, King. King is saying he's sending his kids to summer school to make him smarter. All right, not just to spend his time. Yeah, I know. Many parents are just asking themselves, how the hell are we going to survive the summer? All right, actually, someone need to invent the summer survival kit. How to get through the summer in one piece one piece if you have kids. But anyway, this is another discussion. All right, let's get to Lina. And Lina, this is the second largest US home builders, and it's expected to report a higher second quarter profit on Wednesday. It's going to say that it sold homes at higher prices, but the revenue could have been affected as heavy rainfall in southern United States likely impacted home closings. Lina has a high exposure to Houston in the south, which actually accounted for about 10%, I think, of its total home building revenue in 2014. And I believe we are going to get from Lina lots of what we got in KBH when it reported on Friday, and it was a great stock for day trading on Friday. So absolutely, we are going to put Lina on our stock on Wednesday. Let's get to on Thursday, and beside all the IPOs, we are going to have Accenture, Nike, and Micron. Accenture, this is the consulting and outsourcing company. It's going to report on Thursday its third quarter results. They are expected to be slightly above analysts' average. This is ACN, and let's put ACN on the chart. Okay, looks good, a great uptrend. See, this is exactly the pattern we are looking for. A couple of higher lows and a couple of higher highs. So this is just the pattern of an uptrend, a great uptrend, exactly from it's like taken from the textbook. And right now Accenture has been benefiting from more business from companies looking to cut costs and improve efficiency in a tough economic environment, and they are actually going to Accenture to get all the advices how to make all sort of changes in a very complicated structures of companies in order to move forward, in order to cut costs, in order to push efficiency to a higher level. Investors will, however, look for the negative impact of a strong dollar. Just to get a quick look on the dollar, this is the UUP. Actually, it went downwards in recent weeks, but still, it's just a quiet pullback after a great explosive movement to the upside. And of course, ACN, Accenture, is very much affected from a higher dollar because lots of its businesses, it's not just concentrated in the US, but also over the seas places. Okay, let's get to Micron MU. Micron is going to report its third quarter results on Thursday. It has been on a very, very vicious downtrend since the start of the year, and it's expected to report revenue and profit below analysts' average estimated, primarily weighted down by weaker than expected demand from PC makers. Micron has forecast already lower revenue for this quarter, saying it was willing to hold inventories longer in the face of waning demand for electronics featuring its technology. So analysts and also investors will be keeping a close eye on its fourth quarter forecast and commentary how it expects its DRAM output to fare for the second half of the year. Let's just move to Nike, and Nike reports fourth quarter results on Thursday, and you know, this is just astonishing me one time after the other. We don't have, you know, Nike doesn't have its name on its logo. These are just the logos of each company, and they don't have the name on the logo. They just have the logo, just the graphic itself. And if you give it to anyone in the world, they immediately will tell you, all right, this is the logo of Nike. This is what known as, let me just recall the term. It's not a super logo, something that it's very, very well known. I just missed right now, I just can't recall the term, but the term actually points to a logo that everyone knows, all right? Everyone knows something like a super logo. Everybody knows it, okay? And this is exactly Nike. Now, Nike reports its fourth quarter results on Thursday. This is, of course, the world's largest footwear maker. It's expected to report profit and sales above analyst average estimate. Let's take a look on the chart, and this is a great chart. Actually, it made a new all-time highs on Friday, and seems it's keeping moving higher this early Monday. Right now, the beat of analysts' estimates is expected to be driven by high demand for sports and athletic apparel, basketball, footwear, and strong sales growth on its website and also mobile platforms. So it's all technology, also for the retailers. A recently signed merchandising and marketing deal with the NBA League and its extensive sponsorship at the 2015 FIFA Women's World Cup are also expected to drive growth in coming quarters. So I really like Nike on that. Investors will look for Nike's fiscal 2016 forecast and its comments on its core running assortments, the NBA deal, as well as the overall industry. You know, I wouldn't recommend buying Nike right now, but definitely Nike is one of the stocks that you should keep in your wish list, which should contain all the stocks that you like, that has good forecasts, all right, that are going to drive the economy upwards. And when you have a bloodbath in Wall Street, when you know the bloods will you will have rivers of blood going down the drains in Wall Street corridors, this is exactly the time and place where you want to get into these stocks. All right. Just trying to figure out if we have more time. And Scott, just tell me. I have another thing, but it's going to take us about 15 to 20 minutes. I'm wondering if we should make it or not. This is a technique called a technique that should spot for us oversold stocks that due for a bounce and overbought stocks that due for a pullback. But you know something, let's keep it for the next week. So we will have we will start with it, and because I really want to show you how it's being done. This is the technique for the short term, to actually trying to take stocks from the bottom or just short stocks from the top. We will leave it for next week, and thank you very much for being here with me for the 1 hour plus, for the last 1 hour plus, and hopefully this is useful information. Thank you very much for attending here. This is exactly how we start every week with the Investors Club. I'm going to hand the microphone to Scott. Hopefully you are going all to have a great week. It's going to be a very, very interesting week, especially with what's happening right now with Greece, especially with what is going to happen with all the earnings release that we are going to have, especially with what we are going to have in the IPO arena. You know, I'm thrilled about this week. Hopefully you are also. Thank you very much, and have a great and successful week.